Okay, stream should be up. Yeah, go ahead and add everybody really quick just to make sure everybody that wants to be on is on. Give it about a minute. Stream's up though. So we're going to start off with by obviously asking everybody if they're in current positions or are immediately looking to take positions to feel free. You guys take precedent. So if you're in current positions, you want second opinions on how to manage these, etc., feel free. Go ahead and you can either talk on voice or post in chat. Let's get those taken care of first. Alex earlier before he went to work said that he closed I'm going to post both of these charts so we can look at them. Said he opened up a square trade and he closed it today for 50%. He bought in last week. So go ahead and post a square trade and then also a Rivian trade. Mike, did you guys look at Rivian as a group, or did you and Alex both just happen to take, well, you're still in Rivian, I guess, but did Alex happen to take Rivian on his own accord? He's not going to be on right now because he's at work. Or if anybody else knows. Actually, I'm just going to look at it really quick. Okay, I'm not too sure why he took Rivian or Square. He's not on right now, but he apparently closed his Rivian play for a 90% win and a Square play for a 50% win. I personally don't see why he took either of them. He's not here to tell us why, but touched on this earlier, and I'll bring it up again just in case anybody else is in this same sort of situation. I have one-on-ones with Alex almost every week other than last weekend for personal reasons, but what Alex is working on right now is he comes from a day trading background. He day traded with what group or product? Ross Cameron, I think, the Warrior Trading stuff. He was in there for about 9 months and then decided that it wasn't working for him before he came over here. So right now he's focused on still streamlining his swing trading process because he does come from a significant day trading background. If you know anything about Ross Cameron or the Warrior Trading community, it's 100% day trading. I mean, it's as day trading as you can possibly get with level 2 and everything else. So it's a very big difference. And he is one of the traders that when we were looking through his trader view stuff, I should say, his profitability was being undercut by his underperformance through his day trades. And so we had a conversation, and he wasn't the only person that was impacted by this, but we had a conversation and essentially, why are you day trading? What is the allure of day trading right now? Specifically with Alex, because he comes from a day trading background and he stopped day trading because it wasn't profitable for him. And he said plainly, and I think everybody that I asked, because after I had a one-on-one with him, I asked everybody, were you also day trading on top of swing trading? And then how was that impacting your overall performance? Because obviously in here, we are a swing trading group. You can do whatever you want. You guys are grown adults, but specifically in here, we focus on swing trading. And I said, why do you want to day trade? And he goes, I just really hate when other people can do things that I can't do. And I said, that's totally fine. We're not going to go down this route right now, but focus on one goal. I posted a tweet thread on that today. Focus on one goal. Swing trading and day trading are two completely different vehicles, even though we're trying to capture somewhat of the same sort of idea, right? A piece of price action. But it's different time frames, different methodologies. It's not as simple as just seeing a pattern on a chart and then buying that pattern. It just does not work out that way. And so he stopped day trading, and his profitability now over the last 2 weeks since he stopped doing that is up. I can't say what his overall 2-week performance is because we didn't have the one-on-one last weekend, but he closed his Square and Rivian play for 50 and 90% today, specifically because, one, stopping to day trade, building that consistent process, right? We talked about this at the end of last week. Judge your trades by the quality of the decisions, not necessarily the outcome. Put yourself into a situation where you're consistently making good decisions and the profits will come. And then also, he's working full-time. He's a college student. He doesn't have a huge account. It's not a small account, but it's not huge. And so by eliminating the drawdowns in the account balance portion by day trading, by eliminating that, by just saying don't day trade anymore because you're just flushing cash down the toilet because you're not solely focused on that, and you need to be, just like you need to be swing trading. But also taking these, I don't want to say base hits, but they're definitely not grand slams. For example, you look at Rivian right now, and Mike's looking at this and he's like, why would you sell this? I feel the same way, but because Rivian, obviously, it bounced off a key level. You're now about to hit higher highs. This is crazy relative strength going into potentially breaking the $40 area. Rivian looks fantastic if you're long here. I don't know if I would take it here, but if you're already long like Mike and Alex were, this is great. For Alex's sake, though, since he's building up his account and you're up 90%, if you look at that dollar amount and you go, damn, that could really help me out in the future in regards to making quality trading decisions, take the profit. So he's slowly building his account capital. So every one of these little situations he finds himself in, if he ever thinks to himself, man, that's a lot of cash or whatever, close the trade. First off, because one of Alex's problems is emotionally, he is a little bit more triggered by ups and downs. He doesn't have the same sort of risk tolerance that some of the other guys in here have, which is totally fine. Understanding that and playing to your strengths is fine. We focused on, let's take profits a little bit quicker. Let's build that account out, because by the time you get your account to, let's say, 10 grand, now all of a sudden you're not worried when we post a trade idea and a contract is $300. You're not worried like, shit, that might be a third of my account, or, a quarter of my account, or however big your account balance is. Now you're not worried. You don't need to worry about going and fighting a spread, so you can play the idea, but lower the cost basis, etc. So you're able to put yourself in a better decision environment, if you will, by building that account up slowly. And so he's taking these little singles and doubles, whereas some of you guys in here might have the same positions, but you're looking at these like, damn, this is a great opportunity to hold for a potential home run. Like I said, Rivian looks fantastic here. So Alex, if you're listening to this later, I'm applauding you. And for anybody else that's in the same situation with a smaller account, yeah, everybody wants to hit the Dustin 2,000% winners. But at the end of the day, if you're in a trade that can materially change the way you trade based off of account balance in the future, just take the win, wait, be a little bit more selective, build that account up, and then eventually you're not going to be worried so much about the contract pricing, because your account's going to be big enough to play with essentially anything we find. So good job, Alex. Those are the two trades that I know he closed earlier today before he went to work. Square, I see absolutely nothing what he saw in Square, so that'll be interesting tonight to talk through. Rivian, I do see why. And yeah. So anybody else in any trades that they want to close at the end of day and or are currently in that you want to review? If not, we're going to go straight to Koifin and just going to drop some charts. Go ahead, Marcos. I see you typing. Let's talk through Okta. Try to get a decent screenshot here for the people that are watching the stream later. So OKTA, potential COD to the downside. Horizontal level appeared to be breaking near 60.50. We got the gap down, but immediately filled up. Obviously, now we're seeing sector strength come back into XLK. I'm going to go ahead and post the XLK chart as well. This is a nasty price action here on XLK. Didn't get the full retest across that 128 level, and now we're up and testing those May to June highs again. So this is the level that we were originally using to risk on 8 to 10 weeks ago. We're right back up there testing that same level after breaking down on August 29th. So what would we do with Okta here? If the plan is to go take this to the downside, right, sub 60.50, and you're seeing some sector strength, this still looks like shit. I wouldn't take this trade long or short at this point, but if you're in short, what do you guys think here? Sector strength is slowly coming in, but Okta is not responding well to it. The $1 million question is, do you want to be trading against a potential sector pop-up? What do you guys think? And I don't know if there's a right or wrong answer for this. What was your original stop, Marcos? I'm assuming it's you said 64.50, so like probably right there, that 64.50 area. Based off of the September 2nd and 6th high. Yeah. What do you guys think? I'm going to go ahead and draw on the chart where his stop out is.
This one's hard.
It is hard. It's not just cut and dry. That thick line that I just drew is essentially his stop. Stop makes sense based off charts. You're either breaking down or you're not. In this case, you're not breaking down, but this is not showing relative strength whatsoever. So what do you guys think? These are the types of uncomfortable situations that teach you something. How much premium is left on the spread? You still have 65%? It's a lot more than I thought.
I think I would hold it till tomorrow's CPI number. Maybe you'll get the movement you want. If you don't, then cut it at that point, like right at open.
You can go both ways, right? So let's take worst possible situation here. We gap up off CPI. What do you think this is going to be worth? Let's say we gap up to like 68. You're going to be closing this at like a 50 to 60% loss instead of a 35. Would you be willing to do that? I don't mean to be the doomsday prepper guy, but if you're completely comfortable at closing this thing at and salvaging, 35 or 40% of this instead of 65%, then yeah, probably I think Mike's CPI report idea makes sense. Just be comfortable with the fact that it definitely could gap up and you could be shaving off some of that premium that you're currently sitting in right now. But if that decision sits fine with you, then yeah, I think that the CPI stuff, because you're right there, the 64.50 area is the trigger to stop out. And if you want to run the risk of the CPI report being in your favor tomorrow, or the reward, I guess, of CPI being in your favor tomorrow, run it. Just know that you could be shaving off 20 to 30% of that premium if you do get a gap up. I know you bought time and stuff, so this isn't going to go to zero. You're going to be able to get something back from this if it does gap up. But it's definitely not an easy decision either way. It's not. Trading is mechanical in lots of regards, but these triggers, you're not an algorithm. You don't just have a certain number that you're going to want to close. Obviously, we're discretionary traders. You get to make the decision yourself based off of the best information that you have. And I think if there was no CPI report tomorrow, then maybe this would probably be an easier close here. But I'll mimic what Mike's saying. Okay, anybody else have anything that they're currently in that they want to update, whether it's a winner or a loser? Let's air the dirty laundry here. Make sure everybody is comfortable with their current positions before we move on to potentially opening up new ones. Okay, if that was it, Vinny's typing. I'm gonna pull up Koifin right now. Go ahead, Vinny, you can type that out. I'm gonna post a few sector performance charts here. Nasty moves. Nice moves, but nasty. I mean, they undercut lows. They undercut the lows and then fucking 2 sessions later brought them right back up and some on some pretty decent strength, by the way. it looked like a massive fake out to people that were closing their longs like me at the middle and end of last week, specifically in energy. Not an easy last 5 to 10 trading sessions. Let me go ahead and post all 3 of them. So we talked about consumer discretionary kind of being the area of the market that you're going to want to be looking at the most if you want exposure to the long side and growth. QQQ also works. We can talk through that in one sec. Vinny says he's long the Qs. Go ahead and post your play if you want, Vinny. Which contracts you grabbed on those. Let's pull up the factor analysis stuff. Vinny's hilarious. He's an older guy. He does not understand whatsoever how Discord works. It's great. I think he was like trying to post something and he accidentally disconnected. Okay, while he's figuring out how to reconnect. The year-to-date chart sectors. Anything stand out here that we haven't already gone over? Have trends changed? It kind of appears it actually appears to be a potential trend change. For all intents and purposes, it appears from January 3rd through the 1st of June, maybe the middle of June, most of the growth areas of the market were headed in straight up downtrends. There were various periods of some overperformance, but those overperformance periods lasted anywhere between 5 to 15 days. It wasn't really a sustained rally to the upside, but what happened in the middle of June that caused us to pop over 8 weeks, we were able to capture a portion of that to the upside for some profits. About 2.5 weeks ago, we started to see a drawdown, and here we are once again over the last 3 trading sessions bouncing. So here is the $1 million question. Is this the beginning of a lower high off of the previous high in the middle of August? Or is this the first higher low in the beginning of a trend change on the second half of the year? It's a hard question to ask. What is it? And how can we figure out which one it is? It's a very valid question. And this is what sorts of sets us apart from other groups, is we're not just looking at a singular chart and going, I'm bear, I'm bull. We're looking at the entire fucking market. We're taking a snapshot, in this case, year to date, sector performance, and we're going, listen, where are we in terms of potentially a Wyckoff market model? Is this the first higher low in a second half of the year that could set us up for some bullish moves? Or is this the first lower low off the backside of a mid-August peak? I don't know if there's a right or wrong answer, but if somebody wants to randomly throw something out so I can pin it and make fun of you if you're wrong later, feel free. I have no idea which one it is. If you asked me at the middle of last week, I was still bearish because the trends had not changed yet. But if we look at the quarter-to-date chart and we get this, the concept of this year-to-date, is this the first, higher low off of the lows in June? Is this the first higher low, right? There's oscillations and uptrends just like there's oscillations and downtrends. You're not just going to get a straight parabolic move to the upside. Those aren't sustainable. What are you going to get? It's generally a staircase. You're going to get a higher high, followed by a higher low, followed by even a higher high, etc. Is this a pullback in a potential move to the upside for the second half of the year? Look at the quarter to date. Quarter to date, we're coming up on the very end of this tranche, right? This slice of market history. We're not going to be able to use the quarter to date chart very much more. What does this look like to you? Is this bearish? Is this bullish? And then look at the 5-day. 5-day, obviously, we're making a lot less trading decisions based off of the 5-day because we're looking to hold for longer than 5 days usually. So we're not making trading decisions off of this. But it does give us a snapshot on, over the last few trading sessions, we see some strong bounces. Where has the bounce occurred the most? Consumer discretionary. So even before seeing this chart here on the 5-day, we knew that. Why? Because this morning we looked at XLY and RCD. XLY being your non-equal weighted ETF and consumer discretionary. RCD being your equal weighted consumer discretionary ETF. Everybody, I believe, was in here for this morning session. You understand the prevalence of equal weighted and non-equal weighted ETFs in terms of market breadth. We understand that market breadth is expanding in consumer discretionary. It's not just Amazon and Tesla that are popping here. RCD is the first equal weighted ETF to be testing and at this point clearing those May to June highs. May to June high being that horizontal level figure that you can see right above June. I didn't highlight it in this particular chart, but think about it. The consumer discretionary area of the market is acting better than tech, and it's acting better than communications. So if you want exposure to growth, this is why we were looking at this morning. A week ago, or I shouldn't say a week ago, I'd say maybe 3 or 4 trading sessions ago, I was still bearish, but given the moves, the sustained rally, I wasn't here on Friday, so I didn't see it. Obviously, I'm looking at it today. I'm starting to actually shift my bias more towards the bull side. I'm looking at the trends on the year to date. I'm trying to stay objective. I understand that the CPI data tomorrow can come out and completely shift the narrative, but I'm not taking positions based off the CPI data. I'm taking positions based off of the market information that we have right now. And as of right now, I'm looking at this and I have to make the decision. Is this the first higher low in a move to the upside, or is this the first lower low on the backside of the move? And when I see market breadth expanding, which, let me see if I can get the Bulkowski blog up. We'll see if he posted anything on this. Let me see. He did. He says on Thursday, it's on Wednesday, I believe. He says on Wednesday, market breadth slightly declined during the market pull down that happened for about 12 days. But it did not retrace, as in market breadth did not retrace enough to convince Bulkowski that it was going to be a break to the downside. And in his mind, it seemed like it was a retrace in a new upwards move. Looking at breadth, he's not going to post it today. I think it's every Tuesday or Wednesday he posts the breadth stuff. But breadth is still way better than what it was off those June lows. Consistently improving week over week, other than the 10 to 12 day drawdown. And everything is in his mind, and I'm looking at the breadth stuff right now, specifically with those equal weighted ETFs. It's starting to paint a more bullish picture than what it was last Wednesday. Let's move to industries really quick and see if there's anything that stands out here other than the obvious. Energy. On here, hindsight, it makes those Wednesday and Thursday closes on my part within the energy sector and industries look stupid. But at the time, obviously, we were here and we were in a bunch of those energy plays, and it felt like the world was ending. That's what it's going to feel like if we're trying to catch things in a market that's as volatile as this. But all things considered, if we look at the year-to-date chart, since those July lows in energy, we've been in a consistent uptrend with XOP beating the rest of the market. XOP being up 52.79%. Now, this is not an absolute. This is a normalized performance starting on January 3rd, but these trends are still up in energy. Looking at stuff like TAN, these trends are still up. Looking at the quarter-to-date chart, PBW and TAN, nice rebounds over the last 5 trading sessions. PBW once again reclaiming the lead here, 29.34% quarter-to-date. IGV finally poking its head above SPY. That's your software ETF. That's what we like to see. Remember, when the market just tends to work better when growth is leading. We like it. We've experienced this over the last 2 years. When software is leading, when internet names are leading, the market tends to just feel better. Everything tends to work better. Quarter to date chart showing us that FDN and IGV now firmly above SPY. Let's look at the 5-day really quick. TAN and PBW. Let's look at things like First Solar. Did this hit a new higher high today? No, but it is pressing in the high of day. FDN and IGV both up and over SPY over the last 5 trading sessions. I just saw your message, D-Sharp. Let me go through these factor analysis, then we'll go through your stuff. Factor analysis here year to date. Is anything changing? Not necessarily. Everything appears to be horizontally range bound actually at this point. The beginning of last week, we were looking at a potential breakdown in IWO. We did not get it. IWO being your small cap growth area of the market. That is the most risk on area of the market. Remember, these are relationships between market caps and the major market index being SPY. So we're not necessarily looking to short any of these based off of this relationship. We're just looking to see how these tranches of the market are performing in regards to the benchmark. So right now in the quarter to date, IWO is still leading up 4.84% against SPY. Yeah, the relationships that we've talked about are still showing themselves. IVE is still popping up. IWO is now popping up. So there's no real defining factor here over the last 5 days. The only thing that really surprises me here is IWO, which does. It definitely does surprise me. So if you see IWO breaking or you see IWO performing better than SPY, I mean, there's no other way to put it. It means that the market is buying risky shit again. That's it. There's very few things that I'm willing to like put my foot down and say this is it. But there's only one reason why the market is going to be buying the riskiest parts of the market. And this was a large part of our thesis when the market originally rebounded back in May and June. The growth markets were, if you see things like IWO breaking out, it means that risk is coming back in. 4 trading sessions within IWO I don't think is enough to be screaming, hey, there's risk on back in the market. We're still sub 244, 245 area, which historically was an area that we've looked at to go long above. I mean, this IWO chart's nasty. We undercut the 229, 228 support level that we expected to hold because it was a previous resistance breakout. Now we're right back up and over it. It's just nasty price action. RSI is back above 50. But risk is slowly coming back into the... I shouldn't even say slowly. This is pretty high volume, actually. Risk is coming back in the market. IWO is up 7.26% over the last 4 trading sessions. So with consumer discretionary acting the way that it's acting and kind of seeing how IWO is bouncing, and we know that market breadth is slowly expanding. Yeah, I can't sit here and scream that I'm bearish a whole lot anymore. Things can change on a dime tomorrow based off the CPI report, but the market appears to be not pricing that in. So unless there's some sort of huge miss or something, I wouldn't expect some sort of black swan event. And I think that XOI is probably the area of the market that deserves the most amount of attention if you're looking to get long some of the growth areas. I'm looking at XLC really quick because I remember there was some names like PINS. PINS broke out on Friday. We looked at this on Thursday. It's up again today, 0.39%, 50-day high. So yeah, let's go through energy and let's go through consumer discretionary as soon as I'm done talking or reading your guys' stuff. D-Sharp, I would be willing to laugh at this, but I'm watching it. The pink is yearly channel. The teal is off the most recent high. I would suspect we could test the 200-day SMA. I'm short-term bullish, but that 42.50 area could start the next leg down. That being said, no money. Yeah, no point. Yeah, you don't need to be laughed at. That's totally fine. Markets, for whatever reason, if it's just because, what's the term? Self-fulfilling prophecy. Even if because it's self-fulfilling prophecy, that 200-day moving average tends to work decently well for a gauge for risk. And it also tends to work as dynamic support or resistance. There's a reason why Old school traders will say they only want to go long above the 200 and they only want to look to go short below the 200. I mean, there's some reality to that. If you think that we could bounce back up and test that 200-day moving average before potentially hitting a new lower low, yeah, absolutely. I don't think anybody in here would make fun of you for that assumption. But that means that you'd be looking to go long right now, which is just more fuel to this anti-bear potential bull reversal, right? So if you would expect SPY to potentially bounce here and test that 420 area, I think that the consumer discretionary growth, in the growth portion of the market would probably be your best bet. Buying more PCG, retesting 13. I'll go ahead and post PCG one more time so everybody in the group can see it. This is a very interesting play, PCG. It has an incredible amount of open interest, and it's very surprising to see because it's one of the few sub mega caps, if you will, that has this type of open interest. It's a $26 billion company at 2.91 ADR, so it moves a little bit quicker than most of the other energy names that we've looked at. And I'm not over exaggerating when I say there is a lot of open interest on this play. And yeah, Josh sums it up the best. Anybody that's willing to give their 2 cents in here deserves to be honored and not ridiculed. Unless you're Landon and you're telling me that you're buying something based off of a license plate you saw driving into work. Which surprisingly turned out to be a winning trade. It pisses me off. Marcos, you can take the trade however you want on Octaman. I know that you're right there, and this is one of those coin flip type of environments. And I don't want to say like what we look at in here, we just try to make the best decision that we can based off of the information. And my information that I interpreted as last week, I was wrong. So it's not like what I'm saying is absolutely right. I try to stay objective. If I'm bearish, I want to see the bullish side. It doesn't make sense. If it makes sense, then maybe I shouldn't be as bearish as I am, or vice versa. So breadth is steadily improving. We can look at this really quick. I already posted RCD, which is your equal weighted consumer discretionary. But then you got, some areas of the market that aren't performing as well. Here, actually, let's use the equal weighted Qs here. I feel like since Vinny's in the Qs, QQEW. I mean, that's a very obvious level that we've looked at. Those are your May, June highs. That area of the market to the left, I'm going to draw a little stupid square around it so everyone can see it. Damn near every chart has this squarish sort of consolidation from late May, early June. That's the area that we've been looking at across every single sector and industry, and we're going, okay, are we above or are we below this area? If we are above this area, risk on, motherfucker. If we're below it, we might not be shorting, but at the very minimum, be careful going long. Well, QQEW is now testing that after the drawdown. And look at the Qs here. This type of information is what sets us apart from other groups, because most people are just going to look at the Qs and they're going to go, well, look, we're testing that. Okay, but what is the broader growth market looking like? It's not just the Qs, because there are a lot of instances, which we saw at the beginning of the year, where growth was getting fucking obliterated, like 70, 80% to the downside, and Apple was still near all-time highs. Then what happened to Apple? We know this. Generals tend to get shot last. But that was a clue, because we saw the broader growth market selling off massively prior to Apple. So there were a few of us that shorted Apple with the anticipation, understanding that, listen, if the rest of the growth market is down, it's only a matter of time before Apple comes down as well. Or we were shorting the stuff that was already breaking down, because we knew once Apple broke, it was going to drag everything else down even more. So QQEW is back up and over, or very clear, or very near to being back up and over those May, June highs. That is not bearish in my mind. And we can look at SPY as well. Let's get both metrics on here. Vinny, I don't know if you typed your QQQ position, but if you want to, man, feel free. Let us know what contracts you bought and expiration and strike and stuff. I'll go ahead and draw the same level here with SPY, with that consolidation area, just so we get a general idea. Where are we? So obviously posted SPY, and here is your equal weighted SPY. For those of you that don't know, that's ticker RSP. So this has a little bit more work to do than the Qs do, which makes sense because value is not keeping pace with growth over the last few trading sessions. Feel free to post that cybersecurity ETF. We used to do that. Oh, you did. CIBR. Okay. Yeah. See, that's good. I'm going to go ahead. Let me repost what you just posted. I'm going to draw a square around it as well. And we can use this as a little learning lesson here. By the way, if anybody has any not opportunities, but decisions they need to make, interject. I do not care if you interrupt me. If you have a trading decision to be made, you want a second opinion. But I'm going to take this as an opportunity to kind of plug where our edge is. Based off of Thomas Bulkowski's statistical evidence and work, we have a strong advantage when we're looking at relative strength and relative weakness in terms of industries and sectors. Everybody in here, for the most part, has gone through the relative strength rant with the numbers. You understand that over time, this is one of the biggest empirically tested edges when it comes to trading. And it doesn't necessarily have to be technical analysis whatsoever, right? It's just trying to find areas of the market on an industry basis or a sector basis with relative strength, going along the top 1 to 3 stocks and fucking waiting. That is empirically proven to have an edge. Now, it's hard to find those areas. How you want to find those is completely, everyone has their own ways to do it. We use Koifin and we look at trends. There's other ways to do it. CIBR, if we use that same thought process, okay, what is the overall trend of the industry or sector doing? Marcos looked at CIBR, which is what he's using right now for his cybersecurity ETF. The only thing I'll ask, which I haven't looked at yet, is CIBR a significant portion of Okta's exposure? Let's see. Yeah. Yes, it does. Okay. This is perfect. Marcos did this brilliantly. So when I go to Koifin, I'm going to go ahead and I'm going to post this. So this is paid version of Koifin that I'm posting here. For those of you watching the stream, this is obviously the paid version, bottom left-hand corner, security analysis. I went ahead and filtered it by shares held. Who owns the most shares of Okta? Because obviously they're going to have a big influence in terms of, well, I shouldn't say obviously, but a lot of the times they're going to have a big influence on if they're an ETF, are they buying or selling these shares? CIBR owns 1.9 million and Okta is 2.31% of the ETF. That's a pretty significant portion of the ETF. And that's the second most shares held by any ETF. So yeah, CIBR is a great ETF to look at, the general idea of the trend of the industry. What is CIBR doing? Marcos posted it. We're up and over those May to June highs. Now, what Marcos is not saying is Okta is going to rip to the fucking moon along with CIBR. It's not what he's saying. But what he is saying is, I'm short Okta. I'm at the spot where I am going to be taking my stop. Should I take it today or tomorrow morning based off the CPI? He's understanding the risk of closing now. Maybe CPI data comes out and this thing breaks down. But based off the decision or based off of the information that he has right now, the industry that is holding Okta is breaking out. So barring CPI data does not floor everything, even though Okta looks like absolute shit, he's not going to get the same capitulation move that we had originally thought when we looked at Okta. When we had looked at Okta 4 trading sessions ago, CIBR looked like shit. It looked like it was going to fall off a cliff as well. For whatever reason, the market did not want it to fall off of a cliff. Now we're back on and above a risk-on level. RSI is above the 50. There's some momentum there. There's some sentiment change here potentially. And so he's going, I'm not going to run the risk of holding this until tomorrow morning. And essentially, and I'm sure everyone can agree, praying that CPI data comes out bad. because that's all it would be at that point. Everything is kind of telling him, other than the absolute chart, right, to close that trade. The absolute chart's telling him 50-50. But all of the other evidence that we use in here is telling him that it's a better decision to close the trade today. And he's scraping out 65-ish% of the premium that he paid for that trade, which is a lot more than I'd expected. So realistically, Marcos, you lost 35% on that trade, which, if you're positioning yourself right, guys, should not be a significant portion of your account, first off. But secondly, scraping by, imagine, betting, let's say betting, right? Imagine betting something, losing, and getting a portion of that money back, specifically more than 50% of it. That's fucking awesome. So put yourself in a position to have a good opportunity on a breakdown off of a COD setup. It didn't happen. You're scraping back 65% of the premium to hold for some other decision based off of the industry strength here, and obviously, in this case, QQQ. So yeah, great decision to take the trade. Great decision to close the trade at a smaller loss than potentially tomorrow. I hope everybody understands the thought process behind that, because that, like I said, based off of last week, it's about the trading decision, the quality. Does it make sense? Is it a high quality decision? Because if it is, you do them often enough, you're going to end up making a lot more money than if you're just YOLOing fucking random shapes that you can draw on a chart. Vinny took a QQQ trade off of the bounce of the open. He took a October 21st 325 call. Thank you for posting that, Vinny. I didn't read it originally. I'm going to go and pull up the cues one more time. A 325 call. Sure, yeah. I mean, why not? If the only thing I'll ask you is where are you wrong, I guess? And I guess the only thing you'd be wrong at is tomorrow if CPI is bad and we gap down, right? But yeah, I mean, everything here is setting up for a potential pop to the upside. Qs are still below that May to June high, but if everything is moving above that on an industry basis, I think it's relatively safe to conclude that the Qs are at the very minimum going to test it up near 314, 315. Remember that industries are going to be inherently more volatile than the sectors, and the sectors are going to be more volatile than the indexes. It makes sense, right? Because they're smaller tranches of the market. A lot of the industries are going to have mid caps and small caps in them. A lot of the sectors are going to have some, majority large cap. Not all of them, but most of them are going to be majority large cap. And then obviously indexes are going to have the mega caps and everything. So it makes sense that if the industries are breaking out first, getting up and over those May to June highs, that sectors are going to be second, the indexes are going to be third. Think about it in terms of volatility and what the ETFs house inside of them. That's why we like, for example, trading XOP over XLE. It doesn't always work out, but XOP's ADR is 2.42 and XOP's ADR is 3.29, meaning XOP is generally more volatile on an intraday basis than XLE is. And if they're both trading in the same direction and there's playable contracts on the chain, if you're willing to open yourself up to more intraday volatility, XOP tends to outperform XLE. There's obviously more risk if the trade is wrong in terms of intraday volatility, but if you're comfortable with the volatility and the risk that you're putting into the market based off of the amount of cash per position you're going into, XOP has been a fantastic opportunity for us as a group over the last 2 years. And then remember, even within XOP moves 3.29%, which is bigger than XLE. But then you break down XOP, and what would you expect? You would expect that the names inside of XOP have a bigger ADR. And in this case, the largest company within XOP is Tellurian, TELL, and this ADR is 8.07. So it's massively bigger than XOP. So think about how all of this stuff is interconnected. It sucks. I like EQT, but I liked EQT originally too. I like EQT better here, but I'm afraid to shill it because I know a couple people in here were in EQT and they got bopped out. But I'll post EQT. It looks fantastic here. Look at it. We've been oscillating above the 50 since the middle of July. We're gonna close at what is this? A 7-year high. Yeah, EQT looks fantastic. Problem is you're buying on a 4-day up day in EQT, so you're going to be paying the premium for that. This is what kind of hurts me about last week is I was in positions, I was not in EQT, but I was in energy positions that looked like this EQT play, and I closed in the middle to late last week, and I missed this entire move to the upside. EQT looks great. I like, here's a couple other ones that I like here. I think EQT looks better than these, just based off of a technical standpoint. You got a horizontal level, you're breaking out, 7-year high close. I mean, you can't fucking complain about a 7-year high close unless you closed early. My bad. MRO up and over previous oscillation high, right? Previous oscillation high was set August 29th. Here it is September 12th. We broke up and over it. If we look at some of the major sectors, this is the relationship I was talking about this morning. Look at XLE. Look at XOP. XLE and XOP hit their oscillation high on August 29th. XOP August 29th. But then you have MRO who hit its oscillation high on the 29th, but we're already up and over that today. Why? No idea, but it matters. Why is MRO outcompeting the industry and the sector? What about COP? This was a name that Dustin traded, I think, to a profit last time he was in it, if I'm not mistaken. COP is going to be closing up and over those August 29th highs as well. So this shit matters. Why are these companies being rewarded more so than the sectors and industries that they're housed in? And then you have other names that don't look terrible, but they're not up and over those. So for example, DVN. This doesn't look like a particularly bad play to take, but it's not up and over that 29th high of August 29th. This shit matters when you're coming into, you have 5 names and all of them look relatively the same. How are you going to differentiate between all 5 of them? Look for the ones that are showing the greatest relative strength, and that could be on an absolute basis. So MRO, COP, both looking okay here. EQT looks great. I like EQT more than both of those. The only thing, I'm going to pull up the chain on EQT. We can look at the Octobers or the Decembers. That's the problem. There's no Novembers. Just to see, general price movement on these contracts. EQT today at the money we're going for $1.70, and right now they're $2.11. So these things are up. That's the problem. And you go back 4 days, you go back to Wednesday of last week, you got to fill at $1.09, and these things are up to $2.11 right now. So you are going to be paying for the luxury of having these premiums, or the luxury of buying this breakout, because for the last 4 days the premium has been jacked up. I really, really, really like this ASO trade. But yeah, Vinny, I like EQT. Let's try to buy it on a pullback. Or if you're okay with paying with a premium right now, that's okay too. Because you're right, this is probably the strongest oil name in terms of a technical level breakout, at least how we run it in here. I love ASO here. We do have a div day coming up, actually, now that I'm looking at it. September 14th is a potential div day. For those of you that don't know, typically what we see on div days is the stock drops down by the amount of the div. Right now it says 7.5 cents. So that definitely is not going to fucking do shit. Yeah, we definitely get a pullback usually in the open. But depending on whether or not people want to like close because they captured the divs or whatever, maybe. So I love ASO here. The problem with buying ASO here that I'm looking at is the Octobers have a bunch of open interest on the $55 calls, and I really like that play a lot. The problem is going back to Wednesday, and you got some fills at 48 cents, and now this thing's $1.65. Earlier today, you got some fills at $1.30, $1.31, and now it's $1.65. So once again, paying for that opportunity over the last 3 or 4 trading sessions. So I think I might try to wait for a pullback in here. I love ASO though. I fucking love this. This is an all-time high. It's a retail name. It's a consumer discretionary name. I think that the price point might be I want to be on the left-hand side of that equity expected value curve, rather, not the idiot buying the left-hand side. Okay, we have 10 minutes. I'm going to scan. If anybody has any specific charts or anything they want to look at, throw them out. We'll look at them. If not, I'm going to pull up some 50-day high stuff and we'll look at this. Since we only do have 10 minutes left, if there's anybody that's looking to open a position, you have precedent. So interrupt me or type on the floor. I want to make sure everyone's taken care of before the end of the market. I'm going to stop talking for 2 seconds and pull this scanner up. $50-day high, average volume over 1 million, optionable and shortable, 97 names, posted it on the floor. Go ahead and pull that up if you want. No sector stuff yet. I want to get a general idea of what's moving here. Shout out the Indian bank. Oh man. Marine shipping, energy related names once again up. Progressive once again up, PGR. Mike, how's your Rivian?
Let's see. I'm down like 30%.
Dude, sweet. I can't believe it. That's so.
Yeah, if this can come back up to even, I'll just close that.
As so, dude, you have the Midas touch for this stuff. It's impressive. What's your expiration?
I just wanted to unlock the profit. It's this Friday.
Oh, okay. All right, yeah. So let's hope for a CPI report to the upside tomorrow, and then you can get out.
Yeah.
You locked in the short profit, though, right?
Yeah, exactly.
Sweet. So the names that we talked through earlier this morning are still the names that look the best on the 50-day high scan. We've talked through them a million times. I'm not going to go through them again. I'm going to look at 50-day lows now just to see if there's a common theme here. Chinese names. LI again. Tattered is in here. Tattered, I don't know what your expiration is on that LI player if you're still holding it, but update us when you can, man, because I'm emotionally invested in this trade for you now. Bonds new lows. Here's a fun fractal to study if you want to. Remember, drawing shapes is a great way to risk on or risk off, but boy, it does not necessarily mean something's going to happen. A whole lot of white space on the right-hand side of that symmetrical triangle. So maybe that wasn't really a symmetrical triangle. Who knows? But TLT now down. Not only 50-day lows, but this is a TLT. This is an 8-year low. 8-year low for bonds. 20-plus years. That's crazy. All right, I'm going to get out of the 50-day high and low, and I'm going to strictly go through consumer cyclical. 208 names. I'm going to price them out above $20. 102 names, and change from open up 72 names. If you're looking to go long consumer cyclical, this is a decent scan to scan through. You want only stuff that's necessarily going to have a decent chain. Anything under 20 bucks, you might as well just be buying the shares. Over 1 million volume, optional and shortable, and let's try to only focus on the things that are up and staying up today. Crocs once again on here. TLT. Yeah, my hedge is, well, it was a hedge, so I guess I can't be too upset about it, but yeah, it's dead. Check out this. I don't think this is a trade by any means, but here's a COD. Foot Locker. That is a COD potential breakout above, what is it, 39.5 or 40? However you want to cut that horizontal level up. I'd probably say right here. Right here would probably be a pretty decent area to start to begin risk on that Foot Locker. You scroll to the left, you see that this area had meaning at the end of 2021. So we're now testing it as resistance. It was previously support. We're now trading on the north side of the 200-day. This might be one of the first retail names I've seen trading above the 200-day moving average. And that's a constructive consolidation phase going back probably 20 trading sessions above the 200-day moving average. Held up reasonably well when the market was pulling back. This is a pretty good setup on Foot Locker, actually. Look, RSI's held above the 50 since the middle of August. This was a cheap play when we looked at it last time. It is still very much a cheap play. Wow. There's probably going to be a play that we look at tonight. I don't know if we'd want to take this right now, but tonight we will look at Foot Locker for a potential setup. It's cheap. It's breaking out. It's testing previous resistance or previous support trend resistance, 50 RSI and up. It was a COD, huge gap up, held up reasonably well during the previous market drawdown. Yeah, there's something here on Foot Locker trading above the 200-day moving average. Cool. Look at this tonight. Yeah, it definitely has me a little scared too, Mike. Robin's been saying it all day. VIX doesn't necessarily have to go down when the market's up, but definitely that relationship is a unique one. For sure, D-sharp, 100%. 100%. Okay, guys, we're only about a minute and a half left tonight. We have a session at 7 p.m. Eastern. We'll go through trade ideas, go through the entire market more in depth, come up with actual setups and stuff with contracts. Anybody have any questions prior to market close that need pertinent answering? Proud of you guys for taking initiative. No pun intended at the end of last week. It's nice to see Alex closing those trades for wins and listening to a few of you guys in the DMs that opened up positions last week when I wasn't here. Congratulations. I appreciate it. That's why you're in here. Autonomy fucking rules. Are you going to the game tonight, or are you just going to be watching the game? Nice, dude. Enjoy yourself tonight. Okay, guys, I think that's